Good morning, ladies and gentlemen. Welcome to this morning's webinar in partnership with HVS, AlixPartners, Bird Bird, and EP. This will be our 6th event together that we've hosted together in collaboration, and it's been a pleasure to work with the various teams over these events over the past 18 months. Today, we look forward towards the whole issue of hotel finance and ask the question as to how much have things changed in the pandemic and as we re-emerge. What does the finance landscape look like as we rebuild? One of the most consistent discussion points at this time has been, have things changed more than many people realize over the last year, or will things just go back to as they were once before? Question mark. In recent weeks, we've seen a lot of good news emerge, with forecasts of a stronger than expected bounce back predicted. Do you agree, or is it just a false horizon? What lurking dangers are we still to face? How do the banks feel? Are they confident or are they proceeding very cautiously? Question. Last year, an increased level of insolvencies were forecast for when furlough does finally come to an end. Has this picture become less bleaker, or what has changed? As the Bank of England is now forecasting stronger growth in 2021 than probably most of us expected, and this going into 2022. Reports last week also noted that many economists expect Q2 to grow at about 10%, and growth in 2021 to average around 6.5%, which is encouraging. Economists also believe that this surge will continue not just throughout 2022 and into 2023. If so, that is good news. At the same time, there are numerous reports emerging both in the US and in the UK, which suggest occupancy levels for 2021 will be in the region of 55%. And it will take 4 years to return to pre-COVID levels. Bob Cotton, former government advisor and chief executive of the BHA, has argued that most operators should plan of 60% occupancy levels and work budgets from that base. It is volatile, but it is also encouraging. There are good signs there. However, what do the experts believe need to be considered? We welcome your thoughts today, so please do ask questions via the Q&A, and we will endeavour to come back and answer everything that's asked. Now, may I introduce Lauren to ask a few polling questions. Good morning, Lauren.
Hi, morning. Thank you, Chris. Thank you, everyone, for joining. It's always very helpful for us to put a few polling questions out there, just to get a bit of an insight into your thinking and your situation. So I have 3 for you this morning, and if you wouldn't mind popping your answers, that would be great. So on average, how much more expensive do you think senior debt pricing for hotel transactions will be in 2021 when we compare that to pre-COVID-19 pricing? Do you think it will be a decrease of up to 1%? Will there be no change? Are you expecting an increase of less than 0.5%? Perhaps an increase of between 0.5 and 1? Or do you think the increase will be more than 1%? Very interesting. See, it's the majority of you think that there will be an increase of between 0.5 and 1%. The next question I'd like to pose is, who will be the most active lenders for new transactions to the hotel market in 2021 and 2022, if we look at that by number of transactions? Do you think that will be the clearing banks or domestic banks? Could it possibly be the challenger banks, mezzanine funders? Do you think that it's probably the debt funds, sovereign wealth funds, or possibly peer-to-peer lenders? Interestingly enough, that's a clear majority there. It does seem that most of you think that it'll be the debt funds who will be most active. Final question is, which types of hotel will find it easiest to raise debt finance in 2021 and 2022? Do you think it'll be the holiday resort hotels, possibly city centres, the apart hotels, conference hotels, or the limited service hotels with sort of a limited food and beverage offer? Gosh, this one's a lot closer to call. by a slight, well, I suppose it's not really a margin, isn't it? You think that the holiday resorts are on par almost with the apart hotels, which is on par almost with the limited service hotels. So it'll be very interesting to see from our discussions later how the experts forecast that. Thank you so much for participating, really appreciate that. And as Chris said, please do use the Q&A function and we'll be able to answer as many as possible, either during the session or afterwards.
That's fascinating results, isn't it? Which raises a number of questions, as I'm sure we'll discuss as we go. A pleasure now, thank you, Lauren, that's really kind of you. A pleasure now to introduce Tom Patterson from AlixPartners, who's going to make the first presentation. Welcome, Tom.
Hi, everyone. I'm just sharing my screen. Sorry, 2 seconds. Right. Lauren, can you see my screen?
Yes, Tom, all clear.
Okay, great. Hi, everyone. My name's Tom Patterson. I work at AlixPartners, helping clients raise and refinance debt. I've done a lot of work in the hotel sector, but I've also done some cash flow lending work and some asset finance work across a range of different sectors in Europe. And what I've seen in the cash flow lending market in Europe in particular is that there's been a huge shift in lending from a more traditional banking market to a more credit fund driven market over the last decade since the last financial crisis. And I think that that provides a really interesting read across to what could happen in the hotel financing market. And I hope to cover some of that in the presentation today. So starting off with a recap of where we are at the moment. So the storm has been weathered. It's obviously been really, really challenging for hoteliers and a lot of sectors during COVID-19, but it seems like most people have found a way through. As Chris said, the insolvencies haven't picked up yet. But where are we now? So I think the first thing to note is very positively that most people expect there to be a massive bounce back in trade. There will be winners, leisure, holiday resorts, for example, and unfortunately there will be losers as well. But with 700,000 hotel bedrooms in the UK and approximately 70 million people who are desperate to travel and can't access Europe as easily, it's easy to see why most people expect there to be a pretty impressive bounce back of business. Now, because of COVID, there's more debt on balance sheet, there's deferrals, there's capex to catch up on, and balance sheets do need fixing. And where we come on to next is that incumbent lenders, whilst in our experience, they've been hugely supportive during COVID, giving covenant waivers, covenant holidays, or even injecting new liquidity. They will now need to see that there's a plan for the balance sheet to be fixed, particularly as trading starts to reopen and people get a better understanding of what trading could look like as we come out of COVID. Traditional lenders, whilst they've been supportive of their existing borrowers, our view is that the activity in the traditional senior debt market from the banks for new money is very quiet. The banks have been really busy on their portfolio, but also facilitating government-backed funding through C-bills, through CL bills, and clearly that's across a wide range of sectors. But the bar for deploying new capital is extremely high. And so we've definitely seen a hiatus in traditional bank lending. In contrast, the alternative capital providers, so predominantly the credit funds, they have an awful amount of capital and they really see an opportunity to fill that gap that's temporarily been left by the traditional lenders. And so they're out in the market actively promoting the type of debt that they can provide. And so there's a changing landscape there as well, particularly within hotels. So with all of those factors changing, what that poses the question for me is, you know, I think that there is going to be a change, but is there going to be a slower evolution, or is it going to be a rapid revolution and a seismic shift within the hotel financing market? So that's the question that we pose over the page. So will there be a seismic shift in hotel financing? So the arguments for no is that, first of all, we've all seen how the banks have gone through lots of cycles, and each time they've emerged with appetite for hotel financing on the other side. There are deep relationships between borrowers and banks, and actually, due to the leniency or due to the support that the banks have given their borrowers through COVID, I think those relationships in many instances have actually got stronger as they've worked together to try and survive COVID-19. Another factor, the last one that's on that page, is that alternative financing, especially the headline price, is significantly more expensive. I think the poll there just showed that most people expect there to be a 50 to 100 basis point increase. And through conversation with borrowers in the hotel sector, that is pretty unappealing. If you compare that to what the increase in prices between traditional banking and credit fund pricing, that gap is much more than 50 to 100 basis points. So that's certainly an argument for no, that we're going to stick with a more traditional banking market. Going on to the arguments for yes. So at the moment, hotel transaction volumes are quite low, and cash-backed buyers are certainly able to participate in those processes without too much competition from debt-backed buyers. As those volumes go up, the debt-backed buyers will simply not be able to participate if they don't have the traditional banking products available to them. So they will have to consider picking up the phone to credit funds. So that's an argument for the fact that there's going to be a shift. I mentioned pricing, but actually certain borrowers will think about the cash impact to them. So even though the headline pricing for a credit fund may be a lot more expensive, actually the credit funds are able to accrue interest rather than it being cash pay interest, or not have any repayments and you just have to repay in one balloon at the end. And so actually, even though the difference in headline pricing might be stark, the actual impact on cash could be a lot lower. And the final point is interesting because, as I said, we've been working and tracking the European leverage market for a number of years. And in 2014, 35% of lending activity in that market was done by credit funds. In 2020, 75% of activity in that market is done by credit funds. Bit of a non-normalized year, but even in 2019, it was 65%. So there's been a real shift towards credit funds in that market. And I think that really sets a precedent of the change that could happen in hotel financing. And of course, it's not just traditional banks versus credit funds. We have securitization, we have opco, propco. What's the future for ground rent structures, and are people going to consider an equity option given that balance sheets are already over levered? So there's a number of options to consider. It's definitely an evolving market. And so in conclusion, I definitely think that the hotel financing market is going to become more diverse. I don't think that it will happen overnight because those relationships with traditional banks are just too strong. But overall, I think it will become more diverse, and that's a great thing for borrowers. People have different objectives, and as such, having more financing options to meet those objectives has got to be a good thing. So, final question that I've posed is, how do you position yourself best in an evolving market? And the first step is it's got to be all about your business plan. So we're in a new environment, and really people need to refine their business plans. They need to agree on their target end state. And I'm sure a lot of work's gone on around that, but that really needs to be refined and clear, so you can start thinking about how do you finance that end state. Step 2 in the plan is self-help measures. So clearly hoteliers are coming off a bruising year for self-help measures, but if there is an opportunity to increase cash flow generation, that's going to be useful for every single lender, regardless of which financing option you take. So if there is an option to look internally, and if there is a self-help measure to improve cash flow generation, that will make it a lot easier, keep options open, and ultimately get the best terms. Once you've done that, the next step is, what are your financing objectives? Is your objective to minimize price? Is it to set yourself up for expansion? Do you want to have flexibility around covenants in this uncertain trading environment? So really understanding and agreeing upon your financing objectives has got to be the next step, which then leads into step 4. What are your financing options? In the mid-market survey that I've referenced, we canvassed the opinion and canvassed the activity of over 100 credit funds and lenders, and all of those have different risk and return profiles, different appetite for different sectors, subsectors. Really understanding those options is challenging, but if you can do it, you can make sure that those financing options meet your objectives. And then finally, engage with the market. Now, given that your financing objectives and your financing options may not be totally aligned perfectly, keeping your options open for as long as possible is really important. So what we try to do with a number of our clients is potentially approach 2 or 3 different categories of lenders, and then see what the appetite is in each one of those, and hopefully drive the best terms. So that's the roadmap for positioning yourself best in an evolving market. So thank you very much, everyone. If you have any questions now, I'm very happy to answer those. But if you have any questions after or in a week or so, then please let me know, and I'm very happy to have a follow-up conversation. Thanks.
Thanks, Tom. That was great. Really appreciate it. There are a couple of questions, and I don't know if you would mind hanging on. Maybe we can answer those as James gets ready for the panel. Just 2 quick ones. I don't know if you saw them on the chat. Somebody asked how much of the movement towards credit funds is due to traditional banks worrying about leverage, and do you think that there's an opportunity for hotel mezz finance in the short term?
Yeah, I think there's definitely a gap between the leverage level that traditional banks can get to and the credit funds can get to. And so, yes, that's certainly driving the change. Do I think that mezzanine providers can bridge the gap? I actually think in this environment, it's more challenging for mezzanine providers to team up with senior lenders. The conversations that I've had with senior lenders is that in this uncertain environment, they want to make sure that they have as much control about the situations that they're lending into. And by definition, if you're pairing up with the mezzanine providers, you can try and give yourself some intercreditor protections, but ultimately that is going to result in less control for the banks, who are already a bit nervous about their appetite for risk. So I absolutely think it's an option to consider, but I think a senior plus mezz deal is potentially challenging, and actually I think that that's a a tailwind for more of a unitranche product, which is the credit fund providing all of the financing, which has been seen in the leverage finance space massively.
Amazing. There are a couple of other ones, so I'm sure you'll be able to just answer those online while you're still around for a while.
Sure.
James, that is perfect timing to hand over to you for the panel discussion.
Thanks, Lauren, and thanks, Tom, for that insight, which we'll cover from the panel. And in fact, some of the questions that are coming through, I'll keep an eye on those, so do please keep feeding those in, and we'll try and cover a couple of them on the panel discussions as well to get their thoughts. We sit at interesting times. Hopefully we're moving out of COVID and things are beginning to return to normal. But I think if you take me back 18 months, we were in perhaps one of the most buoyant hotel finance markets I've seen in my career. We've seen lots of new entrants, people coming into the sector, and funders really competing to win deals on pricing and leverage. It was really beginning to become a buoyant market. Obviously, we're seeing ground rents starting to become very popular in terms of the financing structures as well. Fast forward 18 months, I don't think any lender I could have spoken to 18 months ago could have considered that we would be sat in a situation where, for many of them, they had a 100% default rating on their entire loan book. That is beyond the anticipation of just about any lender in the market 18 months ago. So we have dealt with a seismic change in the hotel lending market. Thankfully today I'm joined by a panel of experts, and if they can unmute themselves and come onto camera, that would be great, and I'll introduce all of them. The panel is a group of industry experts who many of them worked on multiple different sides of the lending platform. So if I introduce them one by one, Sarah Green, who has recently set up and is the founding director of Hotel Finance, includes in her time in the hotel world time both at Barclays and RBS on the lending platform, time at Hilton, rolling out their brand and development platform across Europe, and has now moved size yet again to the debt platform side on the brokerage. Merzak Kaddour similarly has sat on many different sides of the platform, formerly head of hotel finance at National Australia Bank and Clydesdale. He's been involved in the lending side, now sat as the investment director at Szabo Properties, who are the apart hotel platform owned by Brookfield. Louise Gillan is head of hotels at Bank Leumi and has been in that role since 2008, which is astonishing, Louise. I can't believe it's that long. Probably one of the most active bank lenders in the market at the moment, and they've been very active even during COVID lending on hotels, which is, I think, is fairly unusual for most of the banks. Hal Shaw has very kindly got up at the crack of dawn, as you can see from, it's probably not even dawn there looking out your window, Hal. What time is it in the East Coast? So they're coming up to 6 a.m. So plenty of coffee for Hal, but Hal is a partner at KSL Capital Partners. And last but in no means least, Peter, where are you? They are Peter Szabo, who is in the European Hotel Transactions team at HVS Hodges Ward Elliott. Thank you, everybody. We touched on in the earlier sessions on the fact that the market has changed fundamentally. The banks are struggling with their back book, with, as I said earlier, pretty much 100% default on a lot of their existing hotel books. And I think as the audience have picked up, as a number of us have said, we think debt funds are now going to be the most active lender in the market. But I think the question is that a seismic change that we are going to see going forward? And I think Tom's kindly pointed out that that's what we've seen in other markets. Sarah, I'll kick off with you, but panelists, please just chip in as and when you feel necessary. So you've got a great oversight of the market. What do you think we're going to see over the next 2 years? Do you think we are now seeing a market that's going to move away from the traditional banks towards those debt funds?
Yeah, I have to say, it's very tricky right now to get hotel deals funded. If I were to sort of give an overview of the market, I think there are merely 5 banks lending. These are not the high street banks, not the traditional clearers that we're used to dealing with. And the reality is, for any hotel transaction, depending on the parameters of that particular bank, you may be ruling out 2 or 3. So you're only getting the ability to talk to a traditional bank about financing a hotel transaction amongst 1 or 2 players. On the other side of the fence, we have this whole swathe of debt funds that have huge swathes of cash that they're so keen to deploy into our market. But the challenge is that this is costly money. And I don't believe it's sustainable in the long term. So they're in this pretty enviable position of having deals to work with that meet the risk profile of high street lenders, but they're able to charge and achieve double-digit returns on this. So I think it's almost a type of bridging finance for now. If you're able to get a transaction away using that debt finance from the alternate lenders, you'll probably find that people are looking to refinance as soon as they can. And of course, everyone's waiting for the high street banks to come back to the market. So I do think it's changing, but is that change going to be there for the longer term? I don't think so. I think the high street banks will come back because I don't think there's any real structural change in our sector. It's almost a case of waiting for hotel trade to come back. And whilst that may take a number of years, I don't think anyone is saying, fundamentally, people aren't going to be staying in hotels anymore.
Thanks, Sarah. And Hal, as one of the debt funds, I'm not quite sure how you categorise yourself as debt fund or alternative lender, but obviously you've been very active and have really sort of been involved in a number of transactions over the last couple of months. Again, probably along with Louise, one of the most active lenders to our market. How do you see things? Do you think this is a seismic change? And you bring obviously the experience of what you see in the US market, which if you look at the history, and we've talked earlier about the leverage market, the UK market does tend to follow what happens in the US. So how do you see things panning out over the next couple of years?
It's a great question. It's frankly not an easy thing to generalize. For KSL, we've been investing in travel and leisure for 30 years. It's all we do. So we're very focused, and I think it's already been stated on the panel. Travel will recover. It already is recovering. You're seeing a lot of strength from the leisure customer. I think the group customer will lag, and we take a big picture view to the space. So when we're looking at today's environment, what we're trying to do is provide borrowers with compelling solutions to help them get through the current situation, and then provide a roadmap ahead. When you look at debt funds generally, I think it's really hard to classify now where pricing is and what a debt fund is, et cetera. The reality is the market has really evolved over the last decade. When you look at the GFC coming out of the financial crisis, we really saw a lot of growth from the alternative lenders. And I think that COVID just brought that, accelerated that trend. And in reality, we partner with senior lenders and the high street banks as part of our execution. And so we can provide compelling kind of pricing to borrowers that is much cheaper than people would expect. And I think a lot of the other truly kind of mainstream debt funds operate the same way. So these types of lenders that are committed to the space, I think, are here for the long term.
Thanks, Al. Louise, I guess one for you to hold up the position of the banks, and I hope when Sarah said there were 5 banks lending, I'm trying to know the 5. I can think of 3. I'm assuming, Louise, you were on that list.
I hope so.
Very definitely.
I agree with what Sarah's saying, that we don't see it as a structural change in the industry. So therefore, I think the high street banks will come back when value comes back. So obviously, we've got to wait for the cash flows to return first. But I think anytime there's an opportunity for new players to come into the market, we end up in the short term with increased, in the long term with increased competition, because as these lenders have come in, they've got to know the hotel asset. They're comfortable with financing in a different way to how the high street banks are financing. And I think that a number of them will endeavour to stay in the financing market for the longer term, perhaps on some of the project financing rather than the stabilised trading hotels. But I think that's a good thing. It has more financing options in the market. I think it's an opportunity for everybody.
Yeah, and Peter, your thoughts? Do we think this is a long-term change, or do we think we'll see the banks back in the market within a couple of years, and we'll be back to a slightly more normal market as we were pre-COVID?
Well, we've seen this cyclicality before with senior lenders pulling back. And they do come back once there's more visibility of the market ahead. And we're seeing that in the US already, actually, that there's a bit more visibility of the market with opening up and people just traveling again. and senior lenders are kind of telling people that they're open for business again. They still might be, you know, in reality quite selective, but that visibility is helping. And you know, in our perspective, once Europe reopens and there's a bit more visibility, senior lenders will come back, and that will also spur transaction activity, because in reality, transactions have been very muted in 2020, less transactions going on in the moment, and once senior lenders come back, there may be transaction activity that is spurred up by not necessarily distress, but just by cheaper debt and that driving pricing.
Thanks. And Merzak, given you've sat on both sides of the fence, how do you see things panning out? Obviously, you talk to lenders across the range on a regular basis and get a feel for what they're thinking. How do you see things panning out over the next couple of years?
I think I sort of agree to an extent with what Sarah and Louise were saying about the availability of debt from the traditional clearing banks. The question is, how many lenders are really active? And listen, I question if there are 5 lenders out there within the clearing banks lending at the moment to the sector. Second question is, at what levels they're lending. We all know that if you're one of the 5 and you subscribe to the economic caps, ECAPs, so you have, I don't know, 1.5 billion earmarked for hospitality. Have you reached that cap? And if you reach that cap through either lending or through the movement, and you've touched on it earlier, James, the PD rate and the probability of default, if that's shifted, then you're talking about what happened 12 years ago, which is a repricing exercise, which is happening. It started to happen at the moment. And interesting, earlier, when we began, a lot of people were thinking between 25 and 100 basis points. Some people have been asked to forecast more than 100 basis points at the moment on a regular basis. We went through the same exercise when I was at the bank. So how many lenders are lending at what leverage and what price? We all love for the clear and the traditional clearers to come back and lend to the sector. Do they have appetite for development or just straight refinance? What pricing? And where's their book sitting at the moment? I think once they go through the repricing exercise, it'll be interesting to see how much headroom there is left. So the debt platforms is a different story. It's a completely different story. They play by different rules, and they certainly have appetite, in my experience.
I think you bring us neatly on to the question we raised to the audience. Where do we think pricing will move to on senior debt? Interesting, just quick answer from everybody where they think, what do they think to that question? Louise, maybe kick off with you, because you have been pricing deals and you've probably got a good sense of where that senior debt market's moved from and to.
Yeah, I mean, we've been working on margin ratchets, so we can't get away from the fact that we're not financing trading hotels at the moment, we're financing closed businesses. So the pricing does have to move, the risk profile has moved. So fine, we're trying to work with each asset to understand what that risk profile is, so that we're not being opportunistic and increasing pricing for a full term of the facility and therefore penalising anybody that's taking finance from us at the current time. As I say, we're trying to work with pricing ratchets so that as the market normalises, so does the margin. However, 2019 margins were very, very low, and I think pricing conditions will dictate that pricing won't get back down to the 2019 levels. It's just not where the market is. So I think it's working with each individual project to understand the risk profile, and for us all to be happy over a medium-term relationship together. We don't want to be putting facilities out there now which are incredibly expensive in 2 years' time, and all of the hard work that we've done now is wasted with refinancing. We want to establish long-term relationships, and being sensible on pricing is one way that you can do that.
Yeah, and Hal, obviously you're offering a slightly different product, but I know from the deals you're structuring that you'll see you're involving senior debt in a number of those deals. What are your views on where pricing's moving at? And I guess you probably get a view right the way across Europe as well, and possibly in the US, in terms of what the pricing's doing over there on senior debt.
Yeah, I mean, frankly, I think that the survey was pretty spot on. It really revolves so much around the banks, because if you think about the bulk of the capital structure, it is really driven by the senior banks. And so depending on where they can price the capital structure, their portion of the capital structure, that will drive pricing. For the alternative lender, the incremental cost of capital is going to be a little bit less volatile. I think it'll price anywhere from the higher mid-single digits and can go up from there, depending on wherever the loan to value sets. But I think that the general direction of what the panel has said so far is accurate.
Great. Peter, Sarah, Merzak, any thoughts on where you're seeing pricing moving to?
Yeah, listen, Hal just touched on it. It depends where the leverage sits. I think at the moment, pretty much, if you look at the UK and Europe, because we are borrowing both in the UK and in Europe, and anything approaching the 55% leverage, depending who you're talking to, and we touched on whether it's a clearing bank or a debt platform at the moment, pricing is really in the mid-single digit numbers, for sure. The minute you go higher than that, you're going to have to pay for the privilege. And the question is, do you need the leverage? And if you need it, why? There's always an optimum level of debt to equity as well. I think the presentation sort of touched on it earlier, the last slide of the presentation. People shouldn't be hooked on leverage for the sake of it. There needs to be a strategy behind it. Either you are doing it for to lever your IRR, or you're doing it because the transaction needs it in a specific jurisdiction. But the pricing is, mid-single digits at the moment for what I deem as conservative leverage, really, at least in the UK.
Yes, and from what we're seeing, the market, as Sarah mentioned, is not very competitive out there for senior lending. So as long as that competition doesn't come back, because the base rate doesn't really have anywhere where to move in Europe, we don't really see debt getting much cheaper. It's really going to be the competition that rates lower.
Yeah, the only thing I would add to that, I agree completely on where margin sits right now, is, traditionally we didn't see heavy arrangement and exit fees in hotel funding. Exit fees were more the domain of real, pure real estate lending. But I'm seeing that in deals and in indicative terms that I'm getting back from not only the challenger banks and the alternate lenders, but it is now a feature of quite substantial arrangement and exit fees.
And I guess one of the questions that anyone looking to do a refinance or finance a new acquisition at the moment is going to be around, well, all of those dynamics are fairly incompatible, aren't they? You've got pricing of debt going up, and you've got hotel performance really quite slow at the moment. And yes, we're expected to come back and hopefully come back strongly. But for a lot of these hotels, they are going to have a ramp up period. They are going to take a little while for EBITDA to get back to where it was. How are lenders addressing that challenge of higher interest bills initially for a new financing, and yet the hotel's just not got the performance initially to deliver that? One of the questions, throw both out to the panel, certainly a number of the deals we've seen, a lot of the lenders at the moment are insisting on interest deposits of somewhere between 12 and 18 months. So not only are borrowers having sort of lower gearing, higher pricing, lower performance of the hotels, they're also having to put up a chunk of cash to cover the interest bill whilst the hotels are still trading and open. Peter, maybe you can kick off with this one. How do we think hoteliers are dealing with that? How are funders trying to accommodate that inherent tension of it's going to be tough for the next year, but how do we get through on a longer, a 3-5 year financing? How do the banks and the borrowers work together to make that function?
Yeah, well, on the deals that we see happening, the banks are taking a long-term view, as you mentioned. So they are looking past COVID very often, and having a belief in the market eventually recovering with no real structural shifts. And the deals that they do end up working on are pretty conservative deals where there's a reasonable recovery and a story within sight. That's part of the reason why there's much more interest in leisure properties. That's part of the reason why there's more interest in the apart hotels. And in the meantime, it's really sharing that plan, like Tom mentioned, and having a good road plan ahead that helps make these deals happen.
Sarah, what are you seeing? Are you seeing a sort of people able to make that dynamic work of the first year of financing with all of those sort of competing challenges, or are you finding it's tough to get, even with the lenders who are lending, it's tough to make that dynamic work in the first 12 months?
Yeah, I think, senior debt is underwritten by consistency in trade and getting comfortable with what the hotel asset is going to deliver. And right now, no one can give you a view on how a hotel is going to trade. And so I think it is quite reasonable for a lender to expect at least 12, I'm oftentimes seeing 2-year requirement for interest cover to sit in a reserve account. And of course, if you're in a capital stack that involves a ground rent, then there's a requirement for cover for that period to be put aside as well. And it's, clearly if you have the liquidity to put that money aside, that's the best position you can be in. But I have been involved in a number of deals where the lender has provided that. So they have actually lent that interest reserve account funding to ensure that you've got a fully funded transaction. So it's very much a requirement nowadays, and there are ways of accommodating it, and lenders who will provide those funding.
Yeah.
Louise, how long do you think these sort of these deposits for interest cover are going to be needed? Is there a sense, do you think, as we move through this year, that starts to drop away, or do we think that's going to be there for a while?
I think when we continued lending at the start of the outbreak, our deposits were for the 2-year period that's been quoted, and I think that was considered to be entirely reasonable at the time. I think now there's a level of optimism in the market. There's some anticipation that the deposit level will get lower, but to be honest, until the hotels open their doors, start trading, and we actually see what that recovery looks like, then we're certainly not going to be changing our requirement for the 2-year facility. I think there's ways of structuring it. If customers have got cash sitting there for 2 years, then yes, I can see them asking very much, can we have that released now? We're out of it, fine. If actually you've structured the facility so that you're capitalising interest for a period of time, then actually those funds are available to the customer for use, and they don't have to worry about interest for that 2-year period, and the cash flow the hotels kick off of their own. So there's ways of structuring it depending on the profile of the hotel for it not to be seen as cash that's sitting there doing nothing for a period of time. But until the hotels are open and trading and we've got more certainty, then I don't see that requirement falling away in the short term, despite the optimism that's in the market.
And how you see, because obviously you see potential on both ends, you can do both whole debt and mezz structures. How are you seeing, because again, there's inherent tension there between those two, one of them wanting the cash deposit, one of them definitely not wanting the senior debt. How are you managing that? What are you seeing, and how long do you think we're going to live with this requirement for cash deposit to cover interest?
It's a good question. I think that the reality is it'll be driven by market forces. But if you look at what a senior lender has to do right now to go get a hotel loan approved, I mean, we just had the most traumatic experience in the history of hotels. And so you're talking about lenders having to go to their committees and saying, I want to make a hotel loan. That's a pretty tough argument to a lot of committees. And so having the reserves in place really helps them get comfort from all the people they have to get through, frankly, to get the cheap pricing the borrowers want. So, it'll really be driven by how long, and as Louise said, the recovery takes. And you need to have a light at the end of the tunnel in order to give relief on this point. But ultimately, it will be driven by the market recovery and competition. From our standpoint, whether we're providing a mezz loan or a whole loan solution, we're typically partnering in some way with a senior partner, and we just deal with everything through an intercreditor agreement, and it's pretty seamless to borrowers. But we view it the same way as the senior lenders in terms of the reserves.
Right. Peter, Merzak, any thoughts on the interest deposits? Merzak, I guess you're on the other side of the coin of being on the borrower side and having to look at these requirements. Clearly, you want to put as little up for as short a period as possible and get the money back as quickly as you can. they're an inherent tension. I guess it means there's an advantage for borrowers who have got a lot of capital behind them or access to capital, but it is going to make it hard for some of those borrowers who just haven't got that capital unless the lender's prepared to give it to them.
Yeah, and I think Sarah touched on it earlier. Lenders, pretty much everyone that I have dealt with, have been more than comfortable to give you that money and put it in reserve. And it is true, it's between 12 and 18 months. On a recent deal in Dublin, we closed it where we agreed to have the money for 12 months, but if things improved, it could be 6 months and the money would be released. You can agree all sorts of things. In terms of whether to ask for it from the lender or to put it yourself, it depends on your cost of equity, of course. Yeah, if you pay less through debt, then obviously it's easier to get it from the lender. But at least you are then feeding the account for a period of time where you give them the trade-in element the opportunity to pick up and do very well. You don't have to worry about the interest repayments. I think it's a good thing. And any pragmatic lender that understands the profile of your asset shouldn't have an issue giving you that money anyway.
Great, thanks. Let's move on, and we have loads of great questions in which I'll come to in a bit. In fact, Helen, maybe let's pick up one of those now, because we've talked about this. Someone's asked, do we think securitization will come and be a saviour to the UK hotel and the European hotel finance market going forward? Now, also know in the US, it's far more common to have hotel securitizations, but the experience certainly we've seen talking to my US colleagues has been around it being much harder for people to get waivers and consents and to deal with those securitized loans during the pandemic. Clearly, I mean, it's been an extraordinary time. But do you think securitization is an option for Europe going forward for hotel finance?
I'm less bullish on that. I mean, I think if you look at what's happened in the CMBS market in the US, it's been frankly a pretty terrible experience for a lot of hotel borrowers. I mean, people are always going to be attracted to cheap pricing and some of the structural elements of CMBS. But what borrowers needed over the past year is a responsive lender who is flexible, and that is not, frankly, what happened with the CMBS market. So I think it just right now has had a lot of challenges. And when you look at the complexity of Europe and everything that it takes to actually securitize a loan, I think Europe had challenges before COVID, and now in the wake of everything that's happened over the past year, I think you'll just see more headwinds on that front.
James, to put it into context, to Hal's point, last year, 2020 saw CMBS in Europe 2.8 billion euros. For the whole 2020, normally it's a lot bigger than that. As we know, the first quarter of this year, 2.1 billion, to tell you that there is a renewed appetite. That's one quarter, 2.1, 2.8 in the whole of last year. I'm also a bit skeptical about securitization for the reasons that Hal articulated there, but it'd be interesting to see. That's also down to market forces and whether appetite resumes from the clearing banks and so on and so forth. It'd be interesting to see.
Thanks, Merzak. Yeah, let's deal with the other one. The other sort of real challenge, and someone raised a question earlier, which Tom tackled, but which is mezz finance. We are seeing a lot of capital want to go into mezz finance. Hal, you're a great example, but we've got clients phoning us up from the Far East wanting to do mezz finance. We've got UK contacts wanting to do mezz finance. I think everybody thinks it's a great idea. The challenge we found, having tried to put a couple of deals together over the last year where we've had separate senior and mezz, is that's been really, really tough to get the senior and the mezz to agree. How you've got on the ground experience, Louise, been to hear your thoughts as well. I mean, the reality is, yes, there's tons of money wanting to do mezz. Getting it away and putting a deal to bed is really pretty challenging right now, isn't it?
I think that's right, but it really depends on what you mean when you say mezz. And I think that when people say mezz financing, they're thinking higher octane financing that really pushes up to, a much more, I would say, expensive point in the capital structure. In reality, for us, I mean, we've done so many loans with senior lenders. We have intercreditor agreements in place. We operate in tandem with a senior lender. So we have one set of documents that effectively are duplicated. One lender will take the lead in the negotiations, either will originate a whole loan and bring in a senior lender or vice versa. And we can make it quite seamless. And there are other lenders in the market who have experience doing that. And when you're thinking about those types of lenders, mezzanine financing is commonplace, and I think you'll continue to see that. But when you talk about a new lender to the space who doesn't have a history of lending to hotels or the intercreditor agreements in place, I think that's going to be very challenging for those lenders to break in.
Yeah, Louise, your thoughts? Obviously, you've seen a number of deals, and presumably you've seen people try and put mezz on them. What's your take in it from a senior lender's perspective?
I would agree that they are lengthy transactions to complete the intercreditor agreement. It's not always straightforward, but it does depend on who your mezz partner is. There are, ways of working together, and I think that it's an interesting solution for assets that are seemed to be overly geared at the moment because we've discounted their value. If we're actually buying into the long-term position that the values are going to come back, then the mezz partner is in quite a relaxed position in the current market. If you're lended at 65% LTV on a COVID valuation, well, actually that's not particularly high. Market conditions normalise. So I think that there's probably scope, therefore, for some of the mezz lenders to work well with the senior funders because they can be more relaxed. And I think that we will need to have some mezz lending in the market over the next year. To be frank, we need to find a way of working together.
Yeah, and Peter, Sarah, presume you're seeing people coming and asking you to put these structures together. I'm guessing you're finding it challenging to get them away. I'm certainly, from my experience, there's a really mixed view amongst the banks on mezz. Some of them are very happy to have mezz. In fact, they actually encourage it, provided it's someone they know and they're comfortable with. And Hal, you're a great example of a group who've got hospitality experience, knows the sector inside and backwards. He's a great partner. As I said, there's other money coming in with no real experience in the sector, but how do you go about when you've got someone coming in saying, I want to do a debt structure with senior mezzanine? How do you go about putting that together and making it work? Because it's not, as we said earlier, it's not simple, but it can be done. And I think, Louise, you're absolutely right. We're going to have to see more of it because the senior leverage from the banks when they come back is coming way down, and there is going to be a funding gap there that needs to be filled. So, Peter, Sarah, maybe you want to grab it. How do you tell a client to put all that together?
Yeah, it's really difficult because it comes down to what deal type you're trying to put that together for. If it's linked to a sale, then in our experience, it's very difficult to give sellers comfort that a bid subject to financing can raise even senior debt, let alone a more complicated structure. So sellers are it's going to be a tough sell for sellers to accept those kinds of bids, and in those structures, we think it's very difficult to put mezzanine in place. When you're talking about refinancing maybe an over-leveraged existing property, then there's more of a possibility and more of a need, and it comes down to having a mezzanine lender and a senior lender that have worked together in the past and are very comfortable with each other, and that helps deals to be put in place.
Sarah, any thoughts with your guidance?
Yeah, so it's interesting because I think mezz is a term that's bandied around so often. There is this gap, and it's a bigger gap than it used to be now, because really on acquisition and refinance, most lenders or the traditional banks, be they Challenger or High Street, I'm not seeing much above 50% loan to value, and so there is this gap that needs to be plugged. I think mezz is a feature of large portfolio size transactions. I think increasingly I deal with single asset transactions, probably between 10 and 50 million. And people think, let's put a slice of mezz in there. But the reality is they're complicated, they're lengthy. That intercreditor is an absolute nightmare to get agreed. And sometimes the size of mezz that's required is too small. The mezz providers are not interested really in much below 10 million. And so I have yet to work on a deal where I've been able to get a slice of mezz away, because in the main, it's the sub 50 million pound transaction. The mezz requirement has been small, and there's less appetite from the mezz providers, because quite frankly, the larger transactions are out there, and why would they waste their time on something relatively small that is just as complicated to get away as a larger deal. Thanks,
Sarah. Let's touch on something else. I think I said on one of these sometime last year that I think with ground rent structures that we saw in 2018, 19, a bit before that coming in, particularly in the UK, that it was going to, the impact of COVID was going to be, if it was hard to finance a hotel, it's going to be impossible to finance a hotel with ground rent on it. Sarah and I are now working on one of those deals, so there you go, I was proved wrong. But for those people who have done ground rents, what's the best advice? How do they go about refinancing them when they've got some debt on an existing ground rent deal? Any thoughts, Sarah, Louise, how somebody fancy picking that one up?
Yeah, so I mean, it is incredibly hard to get senior debt alongside any structure that involves a ground rent, and the key reason for that is, you know, that rent has remained at the level that it's in place for, and of course EBITDA has fallen away substantially. So even when there was limited appetite from banks to support ground rent structures, they were doing it when the percentage of rent to EBITDA was around 10 to 15%. And of course we're not seeing anything close to that now. Then when you layer in the impact of value, there is real concern about how to value these assets. And I think the combination of the rental payable, the value of the asset, means it's virtually impossible to get a ground rent deal refinanced or indeed new debt if it's a sort of mid-market regional asset. You know, if you have a London asset, you know, an upper upscale London asset, I think there may still be appetite for it. It's a different ball game, but by and large, ground rent deals have plugged an equity gap in the past. And, you know, they've been very much a feature of limited service hotels in regional locations. And I think very hard to get anyone interested in that. Even the alternate lenders are not keen on ground rents at the moment.
Merzak, any of your properties on leasehold structures as opposed to ground rents? And I think that's a tough distinction, because I think there is a danger that everyone thinks a hotel on a lease is not fundable. There are loads of leasehold hotels out there that have been funded with no problem at all. Any thoughts of people trying to raise those kind of funding on those kind of structures?
On the ground rent structures, I mean, look, it's interesting, just before COVID turned up on our shores, the ground rent structure almost became an honorary member of the capital stack. It's fascinating how quickly, from March, April 2018, there were deals that were being done on the ground rent. The issue, and I think Sarah has just articulated it perfectly well, the issues around the valuation, which is the biggest issue, the thorny issue. And where you have that crossing of the lines between your rent commitments and your output, your EBITDA performance, and what the valuers see as intrinsic value once they strip out all of those components. I think it's an issue. I think it was always done as a replacement for equity. Let's call it what it really is. I think it's a challenge. I'm not sure how quickly it will come back, because there's been one or two, shall we say, issues with ground rent structures of late on some big portfolios. And I think until we see a revaluation, until we see a refi taking place in a single asset, let alone a portfolio of assets, I think they'll be put to one side for a while. But it doesn't mean that there isn't the right asset for it. And Sarah mentioned on just such one, if you have an upscale asset in London where the trade-in has been proven, and you go in cautiously, and the strip from the income is not substantial, then you could make a case for it. I think a lender could make a case bravely to their committee, but you cannot just offer it everywhere in regional cities and expect committees to sign up to that. I think it's a big risk. Yeah,
I mean, there's no shortage of appetite from the ground rent funds to do ground rent deals. I mean,
yes,
we've seen a number of those still coming forward.
Of course, they love them, yeah.
They want to do those deals, don't they? It's putting the debt on it to trade. But you're right, I think with central London trading performance, it's easy. Clearly, some of the regional ones will be more challenging. Louise, your thoughts on ground rents? You presumably tricky, but possible if it's the right criteria.
Yeah, I think, as Sarah said, look, there is a definition between prime ground rent and secondary ground rent. Those in prime locations, you can build a structure around them. The regional assets, their trading is just too volatile. for you to be able to guarantee to always have, you know, headroom to accommodate a fixed ground rent sum that's only ever increasing. We've always asked for ground rent deposits when we've looked at these structures, and I think partly by requiring the ground rent deposits, it limits the financial engineering to some extent, this increased value when you separate the two out, which means that there's the right amount of equity in the transaction. But yeah, ground rent's never going to be, or, you know, super senior debt is never going to be something that lenders like.
Thanks, Louise. A couple of quick questions coming in. One on LIBOR, which I'll take unless anybody else wants to. Going, what's the impact of the LIBOR conversion to Sonia going to be? Very quickly, I mean, we're seeing a real mix across the banks of what they're doing in terms of the conversion from LIBOR to Sonia. I think the answer is, from a pricing perspective, we are seeing banks pass over. Sonia is cheaper than LIBOR, around about 17, 18 basis points. So I think most of the lenders are simply passing that cost straight on. So effectively, from a cost perspective, there is no change. I don't know if anyone else wants to sort of feed in. We are seeing some of the lenders putting that spread into their margins. So some of the margin increase we'll see come through will be because Sonia is cheaper than LIBOR, and therefore you will see margins go up to reflect the fact that your base funding cost is a bit lower. But that will be my sense. I don't know if anyone's got any wider thoughts, but maybe that hopefully answers the Sonia LIBOR question. Peter, one of the other questions that's come in is on development finance, which I think is probably really challenging. Obviously, Louise, you do it, but Peter, maybe give some thoughts. Louise, Sarah, if you've got other thoughts, by all means, please chip in.
It is tough, and part of that is a lack of visibility. No one really knows yet how the recovery is going to look like, and at the same time, there is still an expectation from quite a few participants in the market that there will be a wave of distress coming. You know, whether that will come or not, that's a question. But if there are going to be distressed properties on the market below replacement cost, then, you know, many of these developments may not make that much sense anymore. So getting development finance right now, especially in some of the markets where there's quite a bit of supply coming online, is tough.
Merzak, obviously you've raised a couple of development financing deals over the last couple of years. What plan going forward? What's that going to look like? Who?
Yeah, pretty much all of our stuff is development finance, really. Listen, I look at it a bit differently, not because I'm sitting on this side of the fence. I think if I were lending today in this environment, it's easier probably to lend on a development finance with a 2-year, 2.5-year horizon than to pick up a refi where I'm not sure of the repositioning of the asset, or maybe if I don't believe very much in the business plan. It's very, very tough because a lot of the assets have been shut. It's different for extended stay. We remained open, as I'm sure you guys know, so that's a different story for us. But if you're a shut hotel that's done nothing for 12 months, I have to believe in the business plan. There has to be something in there that was different from pre-COVID for me to buy into it. I think I would, as a lender, do development finance 2.5 years from now. Either we believe in a recovery in 2.5 years' time, or we don't. I think it's a lot harder probably to make a case for a repositioned asset, or an asset that's going to reopen its doors. And something needs to be tangibly different for me in the P&L that tells me, well, you've shut last year, you performed at X in 2019, but you're going to do Y from 2021 onwards. Y? Explain. If I buy into the business plan, it's fine. I look at it differently. I think, and yes, I agree with Peter. Development finance is tough at the moment. I think mainly because there is still this fear of the sector. I think a lot of the lenders want to see the sector come back to its own. And I think in the second half of this year, we might see things look a bit different, I think.
Yeah, I just, having been an ex-developer, I'm very in favour of development finance, and I absolutely agree with Merzak. I think, if you can finance something now that's going to open 2 or 3 years down the line, it's probably safer financing for the short term. And of course, it's all about getting your fundamentals right. Is this the right hotel in the right location? Is it the right brand? Is it the right management team? If you're ticking all of those boxes, and you're factoring in, how COVID may change how we travel and how we stay in hotels, I think development finance is a safer bet potentially. I think the key thing is there's less money available, so it requires a bigger equity check, and lenders quite naturally are more conservative about how they buy into forecast lending. We never ever thought we'd be in this position where hotels are shut and there's literally no income coming in. So I think development finance is available. It is tricky to get, and you have to be prepared to have a bigger equity stake than you may have had in the past.
Great. Anyone else got any thoughts on development finance? Louise, I know you do some.
Yes, so we're quite active at the moment on development finance. I think they're probably the nicer projects to be looking at the moment. We all hope that COVID is gone in 2 years' time when the hotels open their doors. And yeah, we have to be sensible about what we're building and where we're building it and the structure. But you hope that a nice newly completed asset will actually be an attractive asset in competing against perhaps the older stock in some of the good quality markets. So I think we were concerned at the start that we would have lots of delays on the development projects, but actually it's one of the markets which remained relatively untouched. Building work continued, and the development projects have gone well. So we're positive on the development side of things. Yeah,
I think on a related note, it's also a good time to, when you think about the path forward as an owner, to really look at your property and say, we're going to have a period where we're ramping up in occupancy and performance. This is actually quite a good time to invest in your hotel and invest in CapEx. And if you can find a whole loan solution that will fund some of that cost, and then you can, not without having to develop an entirely new property, you can come out on the other side of COVID with a property that's fresh and can outperform versus your comp set.
Thanks. And picking up a question, which again I'll throw out to the panel generally. Someone said, do we think we're going to see a tsunami of lenders enforcing and assets coming to market as we come out of this, and banks decide, and lenders generally deciding now is the time to pull the trigger and enforce against deals? Anyone want to take that one?
I don't think you go.
Sorry, I'll go. No, go ahead. I'll follow you.
I don't think so. I mean, and if you do, those lenders are going to be they're going to have a pretty short lifespan as lenders. You saw some of that out of the GFC, and I think the lenders that were truly predatory, are no longer in the business. If you want to be a consistent lender in the space, you need to be responsive, relationship oriented, and I think borrowers are going to look at how you performed and how you acted during COVID, as will lenders look at borrowers that way. And so it's been a real litmus test, and I think that this is when the best lenders really kind of show their colors.
Yeah, completely echo that. I think, by and large, lenders have shown great forbearance. They've been supportive of their borrowers. And I think fundamentally that comes down to the fact that, the problem is not the hotel sector. The problem is a global pandemic. And I think structurally, as I've said before, hotels aren't going to change. There are real structural changes in retail and in commercial office space. And so things are being revisited. But by and large, people will continue to travel. Will you get the MICE market back the way it was pre-2019? Possibly not. That may take some time to recover. But I think people will always return to hotels in one form or another. And so I think if it's a good asset and it didn't have problems prior to COVID, lender support will be there. Of course, there will be distress and there will be struggling hotels where lenders do have to take action. But I think, as a sweeping sort of generalization, I think support remains.
And James, just to add to what Sarah and Hal said, which I totally agree with, this brings us back into be careful who you sign up with as well in terms of a facility agreement. I agree with Hal, a lot of the predatory lenders of 12 years ago have sort of disappeared. And one or two who remained, who were wholesalers, shall we say, turned retailers, their reputation now precedes them. And I think you have to be careful who you sign up with, whether within the facility, who you deal with when you sign up with them. So it's not every alternative lender is a friendly lender. The other thing that's worth noting as well, anyone that's been involved in a workout situation, Sarah and Louise will back me up on this one, it is a painful exercise, extremely painful. And I think traditional banks aren't geared up to have the teams behind the scenes to do this when the GFC occurred. They mushroomed those teams, right? They overtook every other team that I can think of. It's painful, it's costly. Quite often you don't get back what you sought to get, what you decided, from the outset as your absolute red line. So I don't think lenders will be in a rush to repeat that exercise. They'll work with the lender, with the borrower, they'll make the borrower part of the solution if it's a decent borrower. I don't think we'll see fire sale. I don't think so.
Great. Guys, I'm conscious of time, and I guess I'll throw out one question to everyone on the panel, which would be, we're starting to see refinancings coming through for deals that were naturally going to expire this year, and yet people are now going back and talking, particularly to the clearing banks, but to a lot of banks, about how they're going to refinance, what it's going to look like, what the pricing is going to be. Now, many of those deals, because of what's happened with the valuation, we're seeing that what was a conservatively, comfortably geared deal pre-COVID is now far racier than a lot of the lenders want to do, and we're seeing a real challenge from some of the borrowers and as to how they manage that out. Do they try and stay with their incumbent lender? Do they try and find a new lender in what's as we've already explored, is a very tough market? And I guess if you've got a financing deal that's running out this year, next year, do you go to the banks now? Do you go to the banks in 6 months' time, 12 months' time, wait for values to rebound? What do you think is the best advice for somebody who has got a refinance coming up this year or next year in terms of taking this forward, and how maybe you can kick us off and tell us what you think?
Yeah, my advice is start working on it sooner rather than later. You need time. I mean, everything just takes longer right now, and the best thing you can do as a borrower is start talking to your key relationships, be open, be transparent, and try to find a holistic solution. I would, don't try to optimize every term. The key right now is to put a good, flexible solution in place that will get you through the next 2 to 3 years, and then the market will be in a different place and you can revisit the refinancing. But if you wait until the last minute and hope that the market recovers, Merzak already touched on a big issue, which is capacity. Those 5 lenders in the market are only going to have so much capacity, and you're really playing a dangerous game if you just kind of wait and hope that things will get better.
James, from my point of view, I echo exactly what Hal said. The earlier you engage with your lender, the better. If it's a lender who you've been with for a while and they understand your business, transparency is key. They know what plans you're putting in for next year, whether you're making some investments probably across your portfolio assets or single asset. Maybe you are repositioning the asset, maybe to capture a certain segment that you didn't go after pre-COVID. Have those conversations. Let that particular relationship manager be your sponsor internally within their organization. You'd be surprised what can be done. What you can't do is expect that what is a 90-day turnaround from the moment I give them the paperwork for them to do the deal. You will be surprised. It won't happen. I think the time to execute the deals as well, I would imagine will be interesting within the next 6 months. Debt platforms move at different speeds, different agility, maybe to the clearing banks. But I think the minute you start having interesting conversations with your borrowers around pricing and business plan, and maybe you don't believe in it, that will lengthen the process to get a credit decision. The sooner the better, definitely.
Peter, do you want to give your thoughts on best ways to do refinancing? Any advice?
Completely agree with Hal and Merzak that you need to talk to your existing lenders quite soon to give them comfort and give them the transparency that they need. In many cases that we've seen with our clients, they've managed to reach an agreement with their existing lender. Yes, the terms might be less attractive than what they originally had, but their view is that in a few years' time, they may be able to refinance. And if for whatever reason you cannot reach that agreement, again, time plays into your favor, that you've got more time to put together maybe a more complicated structure that you will need that extra time for.
Sarah, you
the only thing I suppose I would add is be honest. Early engagement is absolutely key. I think most lenders have come across all sorts of scenarios. Lenders don't like surprises. So be honest, be upfront. If things aren't going to plan, it's okay to tell your lender that, and they will have a way of working through the issue with you. I think I think if you can stay with an existing lender, someone who knows you, particularly if it's one of the big clearing banks, then that's obviously the place to be. Expect to pay more money. There is a repricing exercise going on. I was talking to someone who has in excess of 50 million of senior debt and was complaining because there was a 50 basis point uplift. And I thought, grab it with both hands because that's a good deal, So it's talking. Just talk to your lender. And also, fair enough, scope the market, because there are new lenders coming into play, and there's nothing wrong in seeing what else is out there. But by and large, it's costly and time consuming to change lender. And my sense is that new money is going to be more expensive than existing money, even if it's repriced.
Great, and I'm told we've got a few more minutes, some questions. So find out, Louise, maybe one for you. Someone's asked, do we think the brands will come to the rescue and chuck some money into the structure in the way they did in 2008, 2009, where we saw key money coming in, we saw guaranteed income returns, we saw some of the big brands be prepared to throw money at hotels in order to get them off the ground, to get them refinanced, to get some development pieces away. Do you think that's likely to happen again? And if it does, what's your view on that as a lender coming into the structure?
I don't know. I think if it was going to happen, we perhaps would have seen some of it already, and I haven't. I think there was an opportunity for the brands to have stepped in this closed period to actually have helped with CapEx and get their assets up to scratch, ready for reopening. We didn't see that. Obviously, we know the brands that are quite slow in moving in that regard. So I'm not so sure that there will be any support coming from that direction. It would be a very positive sign if there was.
Yeah, I think the feedback we've seen is that the brands have struggled as much as everyone else in the sector, because obviously their income's dropped off too. I don't know if anyone else sees that coming back. Certainly, we haven't seen any of those sort of proposals on the table yet, but you never know. Anyone got any different thoughts on that?
I think where you'll see more brand support is in flexibility and less hard brand standards. The brands have suffered. Their revenue streams have fallen in line with the fall in hotel trade. And, to be fair, key money is always such a relatively small percentage of the capital stack, and money that's only available at the end of your construction or conversion. I think where the brands can be supportive is in more flexibility and in allowing people more time, perhaps to meet new brand standards. So I think it's a more behind the scenes support than throwing money at the problem.
And James says, we run obviously our own brand, but the one thing I hope the brands won't do this time around, following the year that we've had in 2020, is that to come in with this genius, let's throw in another new concept and a new brand to kickstart it, or let's do a property improvement plan for this asset and that asset, when the guys have been on their knees with lack of cash. I hope there'll be a lot of pragmatism. And if there is anything, it's for the brands maybe to come in and say, we're partners with you. You've signed up for X number of years. We're going to put some money. Even if the key money, as we all know, you have to read in the small print, right? This is not a gift, as we all know. So I hope there'll be pragmatism and they don't end up saddling people with more cash output to reposition the assets, or forever coming up with new brands. This brand didn't work. Rather than shelve it, let's come up with something different and give it a different name. I think there needs to be careful as well.
You've done this before. You're trying to get on our next panel on franchising, aren't you? You're getting ahead of it. Yeah, you're right. I mean, we've not seen that key money coming through. And as you said, Merzak, it isn't a gift, and it is often a factor in the financing. Really good question come through as well, and I think we probably are beginning to run out of time now. But probably chuck one at Sarah and Peter, and I think it's a really tough one. A lot of the money we've seen has been coming out for well-established owners. The sort of the top end of the market for sort of top-end hotels. For the small hotel owners out there, is going to be really tough, isn't it? Because your options are more limited in many ways. You probably haven't got the capital behind you to put up some of the things. Sarah, Peter, the thoughts on if you're a hotelier at the smaller end of the market, well, how do you go about funding now? Because it is a far more challenging market. You probably don't quite have the options of some of the bigger players out there.
Some of these smaller properties, depends where you're located, of course, but many of the smaller properties are in more regional locations, and their recovery, especially this year, next year, might look a bit more positive than larger city center hotels, having more of a leisure focus. So in that sense, there can be some positivity there. And we've also seen some of the challenger banks actually being relatively interested in this space. So that's another way of helping with your financing, and actually the transaction activity that is happening, quite a bit of that is not with the large chunky assets in city centers. It's with some of the smaller assets, and we've certainly seen some owners who have been thinking about selling anyways before COVID, have maybe succession issues, maybe it's a family business, and they think that given the relatively positive outlook and some transaction activity out there, this might be the right time to sell.
Yeah, not much to add to that. I think, fortunately, within the sort of banks that are lending, in the main, they're new challenger banks, and what ticks a box for them is relatively small single assets. So provided, again, your fundamentals are good, it's a well-maintained, well-located, well-operated hotel, I wouldn't be too concerned about raising finance. It's out there and it's achievable.
Great, thanks both. We have now run out of time, so thank you so much for my panel. Hal, it's now got light over on the East Coast, so you can go and have some breakfast. Thank you so much for getting up at the crack of dawn and joining us. Thank you to everyone on my panel. I'm sorry we haven't had time to answer all the questions. We have had a lot of questions today, and we'll try and respond to some of them offline as well, so that people can come back, or you can always email one of us if there's something you particularly want to pick up. Thanks again. Have a good day, and I shall hand over to Russell.
Thank you so much, James, and thank you to all our panelists this morning. Really great to have this topic under discussion. We knew when we sent out the invitations that it was going to be popular. We've had well over 400 people joining us during the course of the morning, and we know that more of you will watch this when you see the recording. So what are the key learning points? I really have taken a lot away from this. We started out with the polls, and fortunately the panel agreed with the audience in the sense that they're expecting somewhere between 0.5% and 1 percentage point increase in the pricing of debt. So we all seem to be in the right ballpark, and it wasn't just perhaps wishful thinking. We think that debt funds are going to be most active in 21 and 22. And there was quite a mixture, nowhere really getting a huge majority of resort hotels, apartment hotels, and limited service hotels, all being viewed as being easier to finance in 21 and 22. Thank you, Tom Patterson of Alix, for leading us through your presentation on whether we should expect an evolution or a revolution. Have the hotels weathered the storm? It seems that so far, judging by the limited number of insolvencies, we're all expecting a bounce back, but balance sheets are going to need to be fixed. Incumbent lenders are being supporting, and traditional lenders at that. But there is a hiatus, as he told us. People are being cautious. There seems to be a huge appetite from alternative lenders, but as we've heard all morning, these can be very expensive, and somewhere in the mid-teens seems to be a consensus. Is there going to be a seismic shift in hotel lending? Perhaps not, but more diverse lending definitely, and he feels that that's good for hotel borrowers. So a 5-point plan: refine your business plan. Have you exhausted all that you can do? Self-help measures, improving cash flows and so forth. Then determine what your finance objectives are and understand your financing options. And finally, engage with the markets, perhaps in parallel rather than sequentially. So we then moved on to our panel, and James asked the panel, is there a seismic change or what? Sarah, as ever, currently hard to get debt finance with only 5 banks lending from the traditional high street lenders. The debt funds, she agrees, are costly and doesn't feel that they're sustainable in the longer term. Hal told us that the COVID crisis has accelerated the trends towards alternative lenders, and often they partner between high street lenders and KSL in order to make deals work. And it seems to be an established custom from his firm's point of view. Louise feels that high street banks will return when values and cash flows return. Peter was confident that senior lenders are going to come back once the visibility of the sector returns. And Merzak, in terms of different strokes for different folks, different rules for alternative lenders. We went on to talk about pricing. We went on to talk about securitization. Doesn't seem to be much of an appetite there. Mezz finance, definitely not for the faint-hearted. And we came back to the topic of ground rents yet again, and it seems as though they weren't a total write-off, even though some of us might have expected that. A brief mention was made of LIBOR and its conversion, and the impact isn't effective. It isn't expected to be that effective. Most lenders are going to pass the costs on, was the conclusion. Interestingly enough, development finance got a better hearing. Maybe I had thought that development finance would have been even more tough, but it seems not. If there is a lack of visibility, then that's clearly going to limit the ability of development finance to be attracted. But if you can build in the timing of the recovery and take time to invest in refurbishing properties, Hal said, now is a good time. So other points that I took away. Sarah, the problem is not the hotel sector, but it's a global pandemic. It's about time we all woke up to that fact. Great point, Sarah. Merzak's words of advice, wise words: be careful who you sign up with, especially in terms of the alternative lenders. And he's confident that there won't be any fire sales. Hal told us to leave plenty of time to put solutions in place. Don't wait until the last minute and hope to get a deal. And as far as Peter was concerned, his comment was, in my words, better the devil you know, even at a higher price. So anticipate the recovery in a few years' time, and that will then work its way in. Sarah told us to be honest, reminded us to be honest. Lenders don't like surprises, and make sure you scope the market well. Louise felt that the opportunities for brands to step in was missed, although it was pointed out that they did have their own problems. And certainly Sarah was of the view that brands can help behind the scenes, perhaps more so. The opportunity for small hotel owners was also briefly covered at the end. Certainly Peter's view was, if it's a regional hotel opportunity, leisure focused, those deals can be financed. And Sarah did feel that the challenger banks such financing could be achievable. So ladies and gentlemen, thank you so much for being with us this morning. On your behalf, I'd like to thank Tom Paterson of AlixPartners for his market overview, to thank our panel, Louise Gillan of Bank Leumi, Sarah Green of Hotel Finance, Peter Szabo of HVS Hodges Wood Elliott, Merzak Kaddour of the Edyn Group, and Hal Shaw of KSL Capital Partners, so ably moderated by James Salford of Bird and Bird. Ladies and gentlemen, it would be remiss of me not to thank Chris Patterson and Lauren Bush, our friends from EP Hospitality and Business, who as always have helped us to put this together. And on behalf of the co-hosts, Bird and Bird, AlixPartners, EP Hospitality and Business, and myself from HVS, I wish you a pleasant end of your day and a successful continuation of your ways that you are getting around dealing with this wonderful situation that we find ourselves in. Finally, and I promise this is my final comment, James briefly mentioned our next webinar, which is going to be on the 16th of June, and it's going to cover the topic of hotel franchising. We very much look forward to being with you then, and thank you again for attending this morning.